Have you ever noticed how the stock market feels predictable when you're watching it, but completely unpredictable when you trade it? Everyone says, buy low, sell high, yet very few actually manage to do it. Why? Because the stock market doesn't work the way most traders think. Behind every price movement, there are institutions, algorithms, and emotions, all fighting for a single thing, your money. Today, we're going to break down how the real market mechanism works, who controls the flow of money, how prices are moved, and how you can finally stop being the prey and start thinking like the smart money. Stay till the end, because in the climax, I'll reveal the one universal rule used by top investors to profit, even when the entire market crashes. The structure of the market. To understand how the market truly operates, you must first understand its players. There are 4 primary categories. Retail traders, that's people like us. Institutional investors, mutual funds, insurance companies, and hedge funds. Foreign institutional investors, FIIs, global funds investing in emerging markets like India. Market makers and operators, those who provide liquidity and sometimes create manipulation. Now, let's be honest, retail traders are at the bottom of this hierarchy. They react to news, hype, and emotion. Institutions, on the other hand, create those very reactions to fill their own orders. When you see a stock shooting up on social media, chances are, the big players have already accumulated it silently weeks before. When the crowd joins in, institutions start distributing, selling to the public at inflated prices. This is the fundamental cycle of the market. Smart money buys in silence. Dumb money buys in noise. So when you next hear about a stock that's booming, ask yourself, is it really starting the rally, or is it ending one? Understanding liquidity. Liquidity is the blood of the market. It's what allows buying and selling to happen efficiently. Big investors can't just buy or sell instantly. Imagine trying to sell 5 lakh shares of a company. If you hit the sell button, you'll crash the price yourself. So institutions use a method called accumulation and distribution. They slowly build positions over days, sometimes weeks, disguising their trades using algorithmic execution. They buy a little, let the price drop, buy again, and repeat until they've built their position without alerting anyone. Once they hold enough quantity, they start pushing news, positive reports, or leaks to make retail traders notice the stock. When the crowd enters, the big investors distribute, selling at a premium. That's why you'll often see stocks rising on good news, and then suddenly falling when everything looks perfect. Because the smart money is quietly exiting while retail celebrates. This is called, buy the rumor, sell the news. How market psychology controls price. The stock market is 80% psychology and 20% numbers. Every candle on a chart represents human emotion, fear, greed, hope, and regret. Let's take a simple example. A trader sees a stock breakout above resistance. He buys immediately, thinking he caught the rally early. But the institutions, knowing how traders think, trigger false breakouts, pushing prices just above resistance to trap buyers. Once enough traders are caught, they reverse the price sharply, forcing panic selling. This is how stop losses are hunted, and liquidity is generated for big players to enter at lower prices. If you look closely at intraday charts, you'll notice patterns like false breakouts, fake pumps, and trap candles. They aren't random. They are engineered to manipulate human behavior. That's why the most profitable traders are not emotional. They follow rules, not feelings. They don't chase, they wait for confirmation. They understand that market manipulation is not cheating, it's just business. The 4 phases of market cycles. Every stock moves in a repeating pattern, called the market cycle. There are 4 key phases. Accumulation phase. Prices stay sideways. Volume is low. Smart investors are quietly buying. Retail is uninterested. Markup phase. The stock starts to rise. Early traders notice and join. Momentum begins. Media starts talking about the stock. Distribution phase. Prices reach highs. Volume spikes. Everyone on social media is bullish. Smart investors slowly sell while keeping prices high. This is the most dangerous phase for retail. Markdown phase. After the smart money exits, prices crash. Retail traders panic and sell at losses. The cycle then resets for accumulation again. If you can identify which phase a stock is currently in, you can stop trading emotionally and start trading logically. The secret of compounding. Let's step back for a moment. Trading can make quick profits, but investing creates wealth. Consider this. 10,000 Indian rupees invested in Infosys in 1995 is worth over 3 Indian rupees crore today. That's not luck, it's the power of time and compounding. Compounding works like this. You earn returns, reinvest them, they earn more returns, and so on. The longer your money stays invested, the faster your wealth multiplies. This is why top investors hold for decades, not days. They're not trying to catch every wave, they're riding the tide. As Albert Einstein said, compounding is the eighth wonder of the world. He who understands it, earns it. He who doesn't, pays it. So while traders chase daily profits, investors quietly build empires. So here's the truth. The stock market doesn't reward prediction. It rewards discipline, patience, and consistency. Every professional trader knows. You can't control the market, you can only control your reaction to it. Stop searching for the next sure-shot tip. Start studying price action, volume, and psychology. The secret that big investors never tell you is simple. They don't win because they're smarter. They win because they're more patient and more prepared. Time in the market beats timing the market. Focus on learning setups that give you a clear edge. Journal every trade. Never risk more than 1 to 2% of your capital on a single position. And above all, stay consistent. Because in this game, survival is victory. Don't try to predict the market. Learn how it moves, and let the profits come to you. If you found value in today's episode, hit that like button and subscribe. Because tomorrow, we'll reveal how FIIs control Indian stock prices. Using hidden money flow patterns you can actually track. See you in the next episode of Decoded Markets, where we turn knowledge into trading power.